Welcome back. For those of you lucky enough to have one, your mortgage will probably be the biggest single investment you'll ever make.
So you're better off trying to save a few pennies on it wherever you can. And financial advisor Paul Merriman from AskPaul.ie is here to tell you how. Good morning to you, Paul.
Good morning,
Paul.
Thanks for joining us today.
No
Lots of great advice on the way. When someone is approved for their mortgage, it's a difficult process, a long process.
Yeah.
And you're so happy to have mortgage approval.
Yeah.
People tend to sign on for as long as possible. They don't want to lose it. They want it for 30 years.
Yeah.
And you're saying that actually there's other options now.
Yeah, there's a load of options. I think you're right. I think what you have to realise that when you're getting your first mortgage especially, it's a very emotional time. You know, you just want the keys, you want to move in, you've got great plans, you're probably thinking about renovating or doing this room up that way, etc. The biggest thing you need to do is to get some financial advice around the mortgage. Don't just walk into a bank. Try and get a mortgage broker if you can to look after the whole market, because there's up to 10 kind of competitors in the marketplace now. So they're all very competitive. And it's unlikely for a client or a person to walk into 10 different banks. That doesn't make sense. A broker will do all that for you. And the reason, I suppose, is the interest rates are the most important things here. When you get in, try not just think about the emotional side, but think about how much money it's going to cost you. And everyone does this on a monthly basis. So say if the mortgage repayment was 1,200 quid and you can afford it, people just go, that's grand, I'll take it. But you have to look at the cost of interest over the lifetime of the mortgage. So what I'm going to do is give you a quick example. If you had a couple that walked into 2 high street banks in Ireland, very well publicised in all the papers and the press, and they went in for variable rate at both banks, there's almost over a 30-year term, there's a difference of 80 grand to the cost of the consumer in relation to the 2 banks. So one is 80 grand cheaper in interest, but they're not that dissimilar on the cost of monthly repayments.
So you mightn't easily see that.
You won't see it unless you're trained, and genuinely speaking, you won't. So most people, when they get the mortgage, never talk about the cost of interest, just how much they can afford in the monthly repayment, and it's the biggest mistake we see people doing. So it's really important to sit down with a broker, go through what the total cost of interest is, and make sure you pick up the right one, you know?
OK, what about people, existing customers who have a mortgage? There's still options there. I never knew you could switch your mortgage.
Yeah, you can switch your mortgage, and I think you're going to find out more about this in the coming weeks, because coming months. The banks are getting really competitive, and we just heard in the last segment there's a big problem with bank arrears, a big problem with house prices in this country, and they basically have a housing crisis. So what the banks are going to start doing is start focusing their attention to people that have mortgages more, I think, over the next kind of 6 to 12 months. So you can switch your mortgage. Now, there's a few rules around this. If you have a tracker mortgage and you have a low-rate tracker mortgage, I wouldn't recommend doing it because you're going to increase the cost. If you have a fixed rate, people think you can't move. You can. You have to pay a small penalty for moving from a fixed rate, but it depends on how long is remaining on the fixed term. But ultimately, if you have a variable rate mortgage over the last and your mortgage is 2 or 3 years old or older, you need to maybe drop me a message or get in contact with a broker and see how much money you can be saving, because the new interest rates are so low that you could be saving hundreds a month, but ultimately tens of thousands over the term of your mortgage. And I say to everyone, the money is better off in your back pocket than in the banks. Like, it's madness. We have a bit of a weird relationship with banks in this country from 10 years ago, so why pay them more? You know?
What about the scenario whereby you've signed on to, let's say, 20, 30-year mortgage, and you find yourself a few years down the road, you've come into a lump sum, you've changed job, you have redundancy pay, perhaps you've been left some money. Is it possible to pay off a lump sum, and will that affect interest rates? Yeah,
it's not. Well, it is. You can pay off, provided you're not in a fixed rate, you can pay off a lump sum. It won't affect your interest rate per se, but you mainly have less to pay, so you pay less interest. It won't affect the rate in some cases. When you're switching or you're doing stuff like that, I think it's important to say, from the term of your mortgage, you're right. A lot of people start off in the beginning and they take a 30-year mortgage and they're paying a packet of interest to the bank. But sometimes you take a 288,000 euro mortgage outstanding at the moment, and if it was a 30-year term and you reduce it to a 20-year term, you're going to save yourself in around 30 grand in interest payments.
20 years can be quite daunting, and people find that their financial situation may change, and hopefully for the better as time goes on.
So I think that's why you need to review your mortgage. When you're young and you may have young children, and you may have creche fees, etc. There's loads going on, so you usually would have an extended term. But the important thing is that once you kind of get into maybe 10 years into the mortgage, or even 5 to 7, any time that you feel more comfortable, you need to sit down with your broker and relook at your mortgage and make sure you're not paying too much interest to the banks, because ultimately this is cash in your back pocket. It just happens over a very long period of time, and that's why people tend to not pay much attention to it. But it's madness. You don't need to be paying that much money to the bank.
OK, we'll talk about mortgage protection in a moment, because I know there's things you can shop around on that front, but there's some new lenders coming into the market.
There are, yeah. So on Puster coming into the market this year, and the credit union, people know that you can go to the credit union and get a loan. And actually, for first-time buyers, I always recommend if you're saving to try and save in the credit union, because the credit union is an amazing place to go to try and get a little bit of borrowing if you need after mortgage for renovation, stuff like that, or just to kind of keep a good record somewhere. I think the credit union is a great place. They do a bit of lending. On Push, they're coming in. I think the important part about on Push is that they're not trying to be, which again is why you need to shop around, they're not trying to be the most competitive in the market. So they're not probably going to have the cheapest rates. So although they might have the best marketing campaign for 6 months, doesn't mean it's actually going to cost you less. So that's really, really important to get financial advice in this. So there's so many lenders out there. I'll just give you a couple of examples. One where you can save 80 grand and one where you can save 30 grand just by possibly having a chat. So I encourage anyone, if you have any questions, it's questions@askpaul.ie or on the Facebook or social media, Ask Paul. Just send me over your details and I'll be able to tell you what you can do.
Very
I'll
key
talk to you off here.
Personal viewpoint. Aidan mentioned mortgage protection earlier on.
Yeah, so this is a big one as well. So a lot of people buy mortgage protection with the banks, which is a big no-no. You just cannot buy your mortgage protection with the bank. If you have bought your mortgage protection with the bank, you need to get in contact with a broker ASAP. There's 6 main competitors for life assurance. So a mortgage protection policy is life assurance. So if you or your spouse or partner died, the mortgage is paid off. You need to go to a broker to get the best products. So the policies are really different throughout all the different lenders, and also there's a lot of price differentiations as well. So if you go into the bank won't have the competitive edge to maybe price match your premium down to the lowest in the marketplace, maybe offer a discount, or ultimately get you the actual best mortgage protection on the marketplace. People think mortgage protection is just a policy that you need, excuse me, and they're all the same. They're far from all the same. They're really different. So, and there's one thing called dual life mortgage protection, which basically, quickly this morning, covers both people on the mortgage rather than just covering the first person that dies. And there's only 2 companies in Ireland that currently do that, Royal London and Friends First. So I'll be encouraging everybody to have a chat with their broker. Again, get in contact with me and we can have a chat about the mortgage protection because it's really, really, really important.
Okay, huge savings to be made.
Huge savings. I genuinely mean that. There's like massive. I see people talking about, I love to pointing people towards bonkers.ie for the utilities and that kind of stuff. When it comes to your mortgage, like don't be just switching your gas.
Is it a massive headache though in order to
It's
switch?
not, and the good thing is, the only thing people don't realise, you do need a solicitor to switch your mortgage, okay? And that's what people generally forget. But some of the banks will give you 2% cash back up front or pay 1,500 quid towards your mortgage fee, so they cover that cost for you as well. So it's not going to cost you anything, it's going to save you ultimately, you know, and that's what we're here to talk about.
It's a smart move.
It is. Very insightful. Thanks very much.
Cheers, thanks for being. Have a good day.
We'll see Paul again very soon. Now